So good morning, everyone, and thank you for joining me and my colleagues to discuss the impact of last year's October budget on succession planning. So since the early 1990s, shareholders of private trading companies have been able to claim 100% relief from inheritance tax. Now, this is changing in just over 12 months' time, and it means that this valuable relief will no longer be available at the current rates. So this morning, I would like to welcome my colleagues Lucy Crowe and Bradley Johnston, who will discuss the implications of these once-in-a-generation changes and will consider planning opportunities for individuals and business owners who are likely to be facing significant inheritance tax costs, which may now have to be borne by the business. I would also like to welcome Mathers and David Cayzer from our corporate finance team. They are going to consider succession planning options and will discuss the funding landscape in the light of businesses potentially having to fund inheritance tax liabilities. They will also look at the increasing importance of having a robust business valuation in place to support claims for inheritance tax relief. Please can I ask that you put any questions into the Q&A section, and I will deal with these at the end of the presentations. So I'm now going to hand you over to Lucy Crowe, who heads up our private client team and who's going to give us a bit of context on the changes introduced in last year's budget.
Thank you very much, Dawn, and good morning to you all. So this morning, yes, I'm really here to introduce everything for you and give you a bit of background before I hand over to my colleagues to really give you what some of the solutions for this might be. So what were the main changes that were announced in the autumn budget? Hopefully most of you have some awareness of this now. It was changes to the inheritance tax and the capital gains tax regime. I think a lot of us were expecting the changes to capital gains tax, but not necessarily to inheritance tax. So we're now really looking at what we do with that. Both inheritance tax and capital gains tax we need to consider for businesses on succession, and this counts whether you're passing a business on in lifetime, whether you're selling a business, whether it's being passed on death. Both inheritance tax and capital gains tax need to be considered. So what changed? We're going to start with inheritance tax this morning. The big changes, as Dawn mentioned, were around business property relief and agricultural property relief. We're going to concentrate mostly on business property relief this morning, but just to give you a little bit of context, there were also changes to AIM shares, which mostly qualify for business property relief, and to pensions. We're not really going to cover those today. We're going to concentrate on the other two, but just to mention, there were changes to those as well. So these changes are going to come in from April 2026, which seems to be approaching us quite quickly. Up until April 2026, if you have assets that qualify for business property relief, or your business qualifies, or it qualifies for agricultural property relief, or a combination of both, you would get 100% relief for the full business property value or the agricultural value. This relief has been reduced to just 100% for the first 1 million. And it's important to note that's 1 million combined of agricultural and business property relief. The remaining value above that 1 million is now only going to get relief at 50%. The inheritance tax is 40%. So it's giving you an effective tax rate of 20%. And important to note here, for those of you that are aware of the nil rate band for inheritance tax, so every individual has a nil rate band of 325,000. If you don't utilise it on your death, it can pass to your spouse, and it can be utilised on the second death. This business property relief, agricultural property relief, 1 million, cannot be transferred between spouses or civil partners. And that will be an important planning point. So to look at some of the problems that arise from this, and these are things that my colleagues are going to give you much more information on as we go through this morning's webinar, but valuations are going to be a big part of what we need to do going forward. For many years, if you've had a business that has qualified for full relief between inheritance tax and capital gains tax, if there's not actually been tax payable at the point of the transaction, there's been no requirement to necessarily get a formal valuation done. So for many businesses, if it's passed down the generations or passed on with no inheritance tax because it's had full relief available, you might not have got formal valuations, so you won't necessarily know what the base costs are at this point. To touch on a couple of the other things that make valuations more interesting for those who are needing to do them. Plant and machinery, I see this a lot with our agricultural clients. One single piece of agricultural machinery can run to £1 million. That's your entire 1 million allowance used up. But for all businesses where you've got a lot of machinery involved and other assets, you are going to need to make sure that that's all being valued as well. Natural capital, anything that might qualify for carbon credits, with businesses needing to look at that more, those assets become very valuable and can inflate valuations. And minority discounts are something that have been around, certainly as long as I've been in tax, been around for a long, long time. But where you've had full business property relief, it perhaps hasn't been quite so important to delve into exactly how much of a minority discount would be available. So minority discounts, if you own 100% of a business, you value the business, and I will defer to my colleague Rod more on exactly how the valuations work. But if you only own 30% of a business or something like that, you don't necessarily have control. The value wouldn't necessarily be 30% of the whole. You might discount it a little further than that. So things that we are going to have to think about a lot more as we go forward with the planning. And the other big issue, and this is going to be one of the things that we really focus on today, is how do you pay the inheritance tax? So my colleagues will go into this in much more detail, but the important things to start thinking about are how are you going to get the cash out of your company? So if your company now is subject to inheritance tax and you've got a large bill looming, if you need to extract that cash out of the company, that may come with its own tax consequences. So it's important to think about that ahead of time. It may be that you can pay the inheritance tax by installments, but again, it would be good to know ahead of time, find out if you will qualify for that, because that could be an important part of the planning. Insurance is also, I think, going to come into play more than it has in recent years. We would encourage people to make sure that you put your planning in place and do any planning that might reduce your inheritance tax liability before you look at the insurance, so you're not insuring more than you need to. That is going to be a key part of the planning, as my colleagues will mention more about. And the pensions are going to come into play. So if you hold assets within your pension, that's traditionally been out with the scope of inheritance tax. It will now come in, but it may be possible to actually pay for some of the tax from the pension. So to canter straight on from the inheritance tax, we'll go on to the capital gains tax. There were two main changes here, both to the rate of tax on assets generally and to business asset disposal relief. So for the main rate, these actually changed on budget day. So up until budget day on the 30th of October last year, residential property was taxed 18 and 24%, all other assets at 10 and 20%. All assets now from budget day last year are taxed at 18 and 24%, except where you qualify for business asset disposal relief. So for those who remember business asset disposal relief as entrepreneurs relief, very similar. If you used your entrepreneurs relief that has used your lifetime limit for business asset disposal relief. If you haven't already used it, either as entrepreneurs or business asset disposal relief, there's a 1 million lifetime limit. And at the moment, that means up to that £1 million limit, gains that qualify are taxed at 10%. That's going to go up to 14% from April 2025, and then up again from April 26 to 18%. So that's quite a significant shift in the tax rate if you're looking to sell a business or are taxable and qualify for business asset disposal relief. There are a lot of other capital gains tax reliefs that are still available. So it is important to look at your planning carefully. And I will now pass on to my colleague, David Cayzer, to start talking more about business succession planning with you.
Thanks, Lucy. I will just share my screen with you one moment. Okay, so morning, everyone. Hopefully you can see that screen okay in front of you now. So I will talk through just some of those options that are available to businesses in terms of extracting cash. First of all, before we go into the different types and ways of doing that, I think it's really just important to think a little bit about pre-sale planning that needs to be done first. No business owner is the same, and no business exit will follow the same path. So it's important to look at each individual business in its own right. And like many things, preparation is key. Make sure you get your own house in order, and don't leave everything to the last minute. Make sure that you've undertaken the research of the market that you're operating in. And key to it is also ensuring that any negotiations and diligence processes are well managed by professional, trustworthy individuals, whether that be your financial diligence or your legal diligence. Part of the process is to be planning in terms of identifying potential purchasers. So that work can already be undertaken well in advance. And ultimately, as a business owner, the sale should really be securing your own financial future, not just in the short term, but making sure that it's suitable for you in the long term and past that. So some really key considerations and work to be done in advance of exiting. So some of the options that are available. Trade sale is one example. So you're selling the business within the industry or outside your industry to another trade. Consideration for your shares may be wholly cash by selling shares to the purchaser, or potentially including your deferred payments or earnouts. And again, with all of these options that we're talking through, you need to consider what those tax implications are, whether that be upfront or deferred. And again, advice on that is key. Another option would be private equity investment. I know Rod's going to talk a little bit more about private equity in his conversation with you today. But again, your private equity involves selling a portion of the equity in the business. And some equity providers are willing to accommodate cash out as part of that process. Probably the most popular and well-known is a management buyout or an MBO, where the directors and first-tier management team will form a team together to take ownership of that business and will already be operating in that business. So the new co will acquire the entire share capital or part at market value, and will again typically involve elements of cash or earnout and vendor deferred consideration. The family succession, known as a FAMBO, again very similar to the MBO, the management buyout, but with family members and options to gift shares to family members. We'll often see here as well some of the assets being extracted first. So some consideration may well be to extract some assets well in advance of doing the family succession buyout. So again, you need to consider things like gift relief, holdover, and any discount on the sale price could potentially be a capital gain, which is deferred until the beneficiary sells the shares. So again, different things to consider from a tax perspective on that one. Moving on to management buy-in. Again, this is where there's entirely a new management team coming into the business, probably viewed as a lot higher risk by funders in terms of the entire management team coming in, perhaps with no hands-on experience or of that particular business, despite having a wider knowledge base of operation. So that is seen as a slightly higher risk. Share buyback is another option whereby companies buy their own shares and reduce the share capital. So again, each shareholder here can get a larger stake in the company and a higher return on future dividends. One thing to remember is that there needs to be sufficient distributable reserves in the first place to undertake that. And again, tax advice is essential in these scenarios. One other possible route to get cash extraction is an employee-owned trust, which have become a little bit more popular in the last few years. We've seen a few more of these whereby transfer of ownership is passed over to employees. Shares are sold to an employee-owned trust, free from capital gains tax, but subject to certain other conditions. EOTs do not involve direct share ownership by employees, rather a controlling interest in company is transferred to an all-employee trust, which is then held for the benefit of the employees. Again, there's different funders will look at these EOTs in different ways, and there's different varying appetite in the market for them. And finally, another way of extraction is a member's voluntary liquidation, which is a formal voluntary liquidation procedure for a solvent business. And this allows the directors to wind up the business, pay off debts, and distribute any remaining assets to the shareholders. So there are many examples of ways to extract cash, all of which need to be carefully considered and advised on appropriately. And at that point, I will hand over to Bradley, who will talk a little bit more on his field of expertise. Thank you.
Thank you, David. I will just share my screen for the viewers. So thank you to David and to Lucy for setting the scene of today's webinar. As you've probably seen, the key theme today is succession planning, and really that now more than ever with the changes announced, it's more important to essentially get your house in order and understand exactly what you're dealing with. As Lucy and David have touched on, there is no one-size-fits-all solution, and actually there are multiple tax aspects to consider. That being said, having your advisors work closely with you and having that trusted relationship with them is fundamental here and has never been more important than ever. Today, I would just like to quickly touch on a couple of routes to sale to complement what David was talking about and the options open for restructuring. This is in terms of mitigating and trying to plan for an inheritance tax liability in lifetime. That said, as Lucy touched on, I will also talk about the means for extracting cash should you be in the position where you need to work out how to fund your IHT liability. So the key considerations that we get with clients, that we discuss with them more recently, has been around seeking a low or zero tax rate. So as you may be aware, there's various tax reliefs, there's various tax advantages that you want to qualify for, and it's fundamental to discuss these up front with your advisor to understand exactly what structuring you may need to do. You should consider share transfers and gift relief. So with family succession, for example, gift relief means that there is no tax liability triggered at the time of transfer. However, it's important to take advice to understand the complexities around gift relief itself. There are husband to wife and wife to husband spousal exemptions that you can take advantage of. And as Lucy mentioned, the availability of business asset disposal relief. Although business asset disposal relief is being increased in terms of the tax rate, it is still a valuable relief that we can work with you to minimise your tax liability. There are conditions such as a minimum 5% shareholding of company shares, and also the fact that the business must be considered trading. So again, important just to seek advice around the availability of this relief. One point which David touched on, which we're seeing as increasing popularity, is the sale of shares to an employee ownership trust. The legislation around this is relatively complex and is being increased scrutiny by HMRC, with legislation announced at the autumn statement. Ultimately, if you do sell a controlling interest to the trust and the business is overall considered to be a trading business, then you should be able to dispose of shares in a tax-free manner. The final point, which David also touched on, is that of a management buyout and a third-party sale. There are various means of consideration which owners can take, such as cash, shares, loan notes, or enter into an earn-out agreement. These all have differing tax implications, and again, fundamental that you understand each of these. In general terms today, I'll cover the fact that cash is typically taxed upfront. With shares, the gain can be held over. With loan notes, this is also similar. And with an earn-out agreement, there's a mixture of an upfront tax liability and a portion which is held over. Where we see often clients tripping themselves up is around the sale and purchase agreement here. If the client is willing to stay on with the business and help with transition, etc., it's fundamental to ensure that any part of the earn-out receives capital treatment as opposed to being taxed as income. Again, we can help with facilitating with review of sale and purchase agreements. Whilst time doesn't permit today, there are other reliefs such as EIS deferral relief available, which we can talk to you about in further detail. Whilst I mentioned that the holdover of gains or the deferral is a good mechanism, it's fundamental to understand the fact that this can result in a capital gains tax liability unwinding at a higher tax rate. Deferred and contingent consideration are often used, and these are a good planning tool to facilitate a cash flow impact and a saving upfront for the shareholder. This always comes with a health check that the deferral means a gain will crystallise in the future, and depending on the fiscal regime, this will likely be at a higher tax rate. That said, a tax loss can also crystallise where the earn-out agreement doesn't pay out what it's intended to at the point of sale. In this case, it's important to stay close to your advisors to understand the implications of deferred and contingent consideration and what this means for the individual shareholder. I'll now turn to looking at some key considerations around the withdrawal of business property relief. As Lucy touched on, this has been a very valuable relief and still is to the point it's in place for passing on businesses to future generations. With the withdrawal of BPR and the reforms that have been announced, you may be in the position where there's a significant inheritance tax liability arising on second death. As we've said throughout, the key theme is that it's important to plan for this, to think through things carefully, and as I can't stress enough, timing is crucial to ensure that you qualify for the available reliefs in order to mitigate this as far as possible. For the purposes of today, we wanted to show an indicative £10 million business and what the IHT position on that looks like. In the left-hand column, you'll see the current position with full BPR relief, resulting in a nil IHT liability. With no planning taken by clients, by shareholders, you'll be looking at a 26-27 position with an indicative IHT liability of £1.8 million. We've also demonstrated the spousal position, so you'll see here the fact of the two allowances being used in order to reduce the IHT liability slightly to the 1.47 million, albeit still sizable from a position of nil. We've been assisting clients with modelling the positions. This helps them to understand the costs and the implications and alternative planning that they can take. I wanted to also flag today, whilst we didn't want to complicate the example on screen, there are the availability of using trusts and also the use of family investment companies, which are becoming more popular. If you are in the unfortunate position that you haven't been able to undertake any planning in lifetime, it's important to understand how you might fund an IHT liability when it crystallises. The declaration of a dividend by the company to fund the IHT liability is the most expensive means of doing so. There's no tax relief available for the company, and it's fundamental to understand the cash flow considerations that the paying of a dividend will cause. Calculations indicate that there could be a combined tax charge of up to 88% by using the dividend method, this being the corporate tax rate of 25%, in addition to the 39.35% income tax charge on the dividend itself, followed by the effective 20% IHT charge, which Lucy discussed. So 88% is obviously very onerous and to bear in mind. One of the little used planning mechanisms, which we see, is the company purchase of own shares. As David alluded to, it's important to take tax advice here to understand whether you will receive capital or income treatment. Clearly, capital treatment is of most benefit, and we've assumed here that there is more than one shareholder, but essentially, if a company purchases shares from the executor as part of an estate, then it's likely that capital treatment would be awarded. A 3-year holding period is looked at in this case, and again, it's important just to seek advice to understand how the shares may qualify. As Lucy touched on, instalment plans for IHT will become far more popular. Companies can qualify for a 10-year interest-free plan, and I would stress the can in that case, as not all companies will qualify. And as Lucy mentioned, there are also term insurance policies which can be looked into. Ultimately, whichever option is decided on, it's important to understand not only the cost to the company itself, but also the cost to the individual. So from today, I hope the key takeaways are that given the changes with the IHT regime, it's important to understand that it may be appropriate to accelerate transfers in lifetime. It's important to have a robust plan in place, and as we see, not many family businesses are in this position. Given the changes, it's important to understand things such as CGT holdover relief, so capital gains tax holdover relief, where no cost may be triggered on actual transfer of the shares, but it's important to plan as early as possible, as we said, to understand the liabilities. This is an opportunity to gather family members together, review plans. We would encourage at least annually, and just to have, moreover, an indicative idea of valuations. And that leads me on nicely to introduce my colleague, Rod Mathers. Rod heads up our corporate finance team, and he will touch on the necessity in terms of having professional valuations.
Thanks, Bradley. Morning, everyone. I'm Rod Mathers, and I'm a corporate finance partner with Henderson Logie. And in our team, we advise business owners when they're looking at an exit or a succession plan. And we also advise on the buy side as well. And most transactions, if not all, there's some kind of valuation element to them. So we do valuations, and I'll talk a wee bit later on about how we go about preparing valuations. I'll also talk about the funding landscape if you want to extract cash to meet IHT liabilities. As I said, we'll finish off by running through valuation methodology. So funding landscape, it is possible to take cash out of the company to fund IHT liabilities, referred to as money out deals by some. But it's really important that the funders that you speak to really understand your motivations and reasons for extracting the cash. Some funders won't look at that scenario, but others will, as long as they fully understand the impact on the business going forward. For example, if you're taking on debt in the company and how the financial position of the company is impacted. Some equity funders would consider a combination of money out to fund your IHT liabilities, but they'd also consider investing into the business if you're looking to grow it as well. But that's a whole different scenario, and you need to really present your business case and your business plan for that scenario. So lenders, if you take on debt into the company, lenders are focused on security and the company's ability to repay the debt, and I'll talk a wee bit about the differences between debt and equity. So first of all, Debt. If your company is looking to take on debt, ideally it would be lent against assets in the company. So that could be against debtors, it could be property, it could be plant, it could be stock. And the type of funding will depend upon the security that's available. There's also an opportunity to raise debt against cash flows, but you need to demonstrate that the company is profitable and is stable and generates cash. Key things are, without stating the obvious, is that bank debt needs to be repaid at some point and it's interest bearing. So you need to factor that into account if you're thinking about taking on debt into the company. And typically the lender would look for security, and whether that's asset backed in the company or whether it's a personal guarantee, which is something you shouldn't go into lightly. So you need to think carefully before you're asked to give a personal guarantee. As I mentioned, the lender would also consider cash flows and lending against cash flows, but in that scenario, you'd likely require to give some covenants. So DSCR and CFADs, so they're two of the most common covenants. So DSCR's debt service cover ratio. So that's a ratio of your profitability versus the debt repayments, capital interest, and CFADs is cash flow available for debt service. So these are two main covenants, and they'll be built into the facility documentation, which is the main documentation between the company and the lender. So in summary, lenders will want their money back with interest if that's a scenario that you want to look at. We just turn on to equity. So equity is typically provided to fund investment in a company or an acquisition or development capital, and typically for high growth businesses. When you take on equity, you need to demonstrate the risks, because it's more of a risky investment, because it may not be backed by any form of security. So you need to understand the risks and articulate that to the equity provider. Equity can also fund losses in a company if you're developing products or IP. The important thing is to note about equity investment is that the existing shareholders will be diluted. So you will have another shareholder on your cap table that you need to manage and deal with. And basically, equity providers get their money back by increasing the value of the company, and that's either through getting a higher multiple on an ultimate exit than they did when they invested in the company, and also increasing profits. So that's helping the company grow, maybe enter new markets and become a more profitable company. So equity providers typically look at the return that they're going to make at the end of the day, sometimes called an IRR. So when you're presenting a business case to an equity provider, it's important you can demonstrate that the returns they'll make on a subsequent exit meet their expectations. And the main form of a documentation is a shareholders agreement, which is a whole separate subject. So basically, if you're thinking about taking on equity or investment, you want to make a return on some kind of exit in the future. So just move on to business valuations. Can be required for various reasons, and it's really important to understand why you're looking to get the business valued. There's not a right or wrong answer. And the approach may depend upon the purpose of the valuation. But as my colleagues have said, when you're planning for potential IHT liabilities, HMRC, as Lucy said, HMRC are probably going to take a more interest in how the business was valued. So we can see a lot more valuations being required for businesses, and it's almost a kind of insurance policy, in that if it's ever challenged when you've done your tax planning and HMRC maybe challenge it later on, that you've got the supporting documentation, to basically verify the value that you've included in your tax planning. So valuations, if you look at a company sales scenario, and I'll come on to this in a minute, but typically you apply an appropriate multiple for that industry to maintainable earnings. And that gets you to your value or your enterprise value. If you're looking at a valuation for growth capital, it could be a combination of historic trading, and it could also be projection led as well. And if you're looking at debt funding, debt funders like to look back the way as opposed to forward. So they like to understand the historic cash flows of the business. So key terms and valuations. So enterprise value, and some of you will be familiar with some of these terms. It's basically the value of the company without taking into account of how it's funded. So that's you applying a multiple to a profit figure. The equity value takes into account of how it's funded, and it's basically the net value to the shareholders. And I'll come on in a minute to give you an illustration of that. Multiples, it really depends which multiple you apply to your profit. Depends on the industry, depends on the kind of economic cycle. And that's when we do valuations, we do quite a bit of research into multiples, what's been paid for companies recently in the same kind of industry, what trading companies are trading at, or public companies are trading at. So it's, again, there's no right or wrong answer to the multiple, but it's important that you've got justification to apply. Normalized or adjusted EBITDA. So EBITDA is it's a term. It's earnings before interest, tax, depreciation, and amortization, and it's often the number that a buyer will look at to apply a multiple to come up with a valuation. But in typical family businesses, private owned companies, the reported EBITDA is maybe not the normalized position, because perhaps the shareholders are taking dividends as opposed to salary. So you need to normalize directors' remuneration, shareholders' remuneration to get a normalized position. You also want to take into account one-off costs or exceptional expenditure. There's also important to recognise what the working capital position is of the business at the point where you value it, particularly for seasonal businesses. So there might need to be an adjustment to reflect a kind of normal level of working capital. Cash-free, debt-free is a term that's often used in transactions, and it's basically the enterprise value, because it doesn't take into account the way the company is funded or any surplus cash. So that's really kind of an earnings-based valuation, but there's also different ways to look at valuing companies. One being the asset-based valuation, and that's maybe more applicable to, for example, a property company or a farm, agricultural company. So it really depends on what type of business, and there's different ways of valuing companies. For farms and for property companies, you really need to get experts in these fields to do the valuation, whereas we typically look at trading businesses. So how do you approach a valuation? So, as I said, understand the purpose of the valuation. You'd review the trading history, review the forecast trading of the business, determine a valuation approach, review the balance sheet position of the business. It might be that the balance sheet value is actually greater than the earnings value, in which case you default to the assets, the net asset balance sheet value, and you arrive at a determination. So there's no right or wrong answer. That's the kind of basic principles, and these are kind of the principles that we tend to apply. So we need to really understand the business when we're valuing it, to make sure that we can back up our methodology. And just to conclude, some of you might have come across a term called enterprise to equity bridge, and that's basically taking or reconciling the enterprise value to the equity value. So, for example, in a business that's valued at £10 million, if you just apply a multiple to profits, there might be surplus cash in that company, so you'd add that on to the value. There might be committed capex, so there might be replacement capex that has been committed, so that would be considered as a debt item, so you take that off the value. Corporation tax is often a debt item as well, so you take that off the value. There might be a bank loan in the company. Again, that's debt, so that would come off the value. And accrued bonus as an example, so that would come off the value as well. So you get to an equity value of 6 million after you add on the cash and take off the debt items. So you can see that the equity value is what's actually left for the shareholders. So that's how you kind of reconcile the enterprise value to the equity value, and it's the equity value that you basically pay the tax on, the value of the company. So that's a simple illustration, just to kind of finish off. So I think that's all from me, and I'll maybe hand back over to Dawn to facilitate a Q&A. Thanks
So
very much.
thank you very much, Rod, and thanks very much to all the speakers. If anybody's got any questions, there's a wee Q&A box at the end of this, at the bottom of the screen. Please just put in any questions, and we'll do our best to answer them for you. So I have got a few questions of my own, so I'll just start with my questions, and yeah, please just feel free to populate that box. So Lucy, do you think that we're going to see the gradual phasing out of business asset disposal relief, and in particular the lifetime allowance, because obviously that has been a very, very valuable relief used in succession planning to date?
It's a very good question that we've certainly seen it reduced significantly by April 2026. That 18% rate is a big difference from the current 10% rate. It certainly wouldn't surprise me at that point to see it disappear altogether. But I think for that one, we'll just have to wait and see.
Okay, thank you. And probably another question for you, Lucy. What type of insurance can you get to fund IHT liabilities?
So for insurance, I normally go and speak to a good financial advisor. But there are many different types of insurance. You can insure your sort of whole life cover, or you can insure a particular part of your IHT liability. So for example, if you were to gift assets away, but there's a potential IHT liability until 7 years has passed. So a lot of IHT planning works on the basis that once 7 years has passed, that the liability is gone completely. You can very often insure just for that 7-year period. So a lot of differences. It will depend. The cost of the insurance will very often depend on someone's age, their health, how much you're insuring. So I would always say get a good financial advisor to help you with that, but also make sure that you've put a lot of your planning in place first, so that you are just insuring what you need to, and you're not insuring the whole liability and then reducing that massively with planning, but you're still paying to insure what you originally had as liability.
Okay, that's great. Thank you very much. Bradley, one for you. Base cost, when you're looking at capital gains tax, what's the start date for that? Could you maybe just explain the start date and the March 1982 position?
Absolutely. So your base cost is typically your acquisition cost when you first acquired the asset, including sort of any incidental costs of acquisition at the time. As Dawn alluded to, the capital gains tax rules were rebased in March 1982. Therefore, if the date of acquisition was before this date, then you use an indicative valuation as at March 1982. Again, it depends if your capital gain arises in a company or if it's on an individual, obviously subject to different rates of tax and slightly different regimes.
Thanks very much, Bradley. Question for David. Are you seeing any particular trends in the route to sale, noting the various options that you have already set out?
Yes, certainly there's been I think I mentioned there's a trend towards employee ownership trusts. So we've definitely seen a little bit more of that recently. And the key, of course, for that sort of transaction is making sure that it's being done for the right reasons as well. So yes, it can be a tax efficient way of extracting cash, but it's also important that it's being done for the benefit of the employees and not just for the exiting shareholders. So we are seeing more activity around that side of things. Management buyouts continue to be seen, and I think also trade sales and private equity, to be honest. The trade sales are picking up. We've undertaken a few ourselves recently that we've been involved in, and successfully seen those get sold. And private equity remains buoyant. There's a lot of cash in the market still to be invested, and it's one of those things. If you've got a really good business, there's generally somebody out there who will fund it, whether it be a traditional lender, a challenger bank, or private equity. So I think in those areas, certainly we're seeing continued activity.
Thanks very much, David. One for you, Lucy. So farmers are understandably very upset with the inheritance tax changes. Do you think the government are going to make any further changes in the up and coming legislation?
We've been waiting for that legislation to come out. I suppose just to give a bit of context, the legislation, once the budget was announced, the consultation ran till the 22nd of January this year. And we have a spring statement coming out on the 26th of March. So we're hopeful that if we haven't heard anything by the 26th of March, we will get a bit more clarity at that point. I think there's been an awful lot in the news. There's been an awful lot of protests. I haven't as yet seen anything to indicate they are going to change anything significantly. So I think we do need to carry on planning on the basis that these rules will come in. I think any tweaking will be fairly small, but I have been wrong before when a budget's been announced, so we'll have to wait and see.
Yeah, very difficult to know what they're going to do. Okay, so I think we've got time for maybe one more question, and I can see there's quite a lot in the chat, and then we can come back to you following this presentation. So there's a few questions on family investment companies. That's maybe one first for Lucy, and or Bradley can take this one. So I suppose, have you seen an increase in interest in family investment companies for IHT planning when trusts are not a good option?
I don't know whether you want to add anything to this, Bradley, but I think it's something Bradley and I have actually been working on an awful lot together. We've probably been doing more work on family investment companies and with Dawn as well in the last 6 months than we had in the sort of 6 years prior to that. I will say that one of the solutions we see being the most effective is actually often combining family investment companies with trusts. So I'm not sure it's always an either or. Sometimes a combination of both can be very effective.
Okay, so we'll maybe do one more, and then I will wrap up. So this probably is one for you, Bradley. Is there a concern that holdover relief and other deferral options are just a case of kicking the can down the street, because obviously there's going to be a higher tax liability in the future if rates were to potentially go up?
That's right. It's certainly a valid observation, Dawn, and I think there can be a tendency to think that. I think what it does at the current stage or the current day is it gives you that opportunity just to plan around actual cash outflows from the business, and just gives you certainty and security that there isn't a liability today. We would obviously advise clients when we do think about deferral reliefs, for example, we would always highlight that there's the possibility that it will crystallise at a higher rate. But as I say, it can just be it's a cash flow consideration and a planning tool really for now. And obviously, as we don't know, we can't forecast what may happen down the line in terms of tax rates.
Okay, thank you very much. So there are still some questions which we haven't answered. We will come back to you. We're nearly out of time now, so I'm just going to draw the session to a close. I do hope you found our presentations helpful, and it's really great to know that there are opportunities to plan in the light of all of these changes. You will be sent a copy of our slides, and please let us know if you have any further questions. Our contact details will be on the slides, and we will sort of pop out an email to those of you who we haven't managed to answer your questions. So thanks again on behalf of the team here at Henderson Logie, and I hope you all have a great day. Thank you.